Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. There's a good question here that I'm going to answer. It says, I understand the company that you work for manages your 401k and starting in 2022 allows you to invest in ETFs. My question is, if you were personally managing your own 401k and not your company, would you be in ETFs or would you be investing in the individual companies you show us on the channel? I would not invest in a single ETF. I would do exactly individual companies that you see on the channel. I would overweight. Basically, what I'm doing is I'm creating my own ETF. I would overweight my favorite companies, and I would ditch 75% of the fund, which I think is complete garbage. That's what I think. So I would be more heavily weighted in the companies that I own, that you see on the channel, and that's what I would do. And I would be in a lot of commodity companies, physical precious metals. If there was no bounds to a 401k, if I could do whatever I want, I would probably load up on physical metals. I would put maybe half of my 401k in physical metals and half of it in individual companies. And that's how I would run it. I don't need someone else to manage the money. In fact, I would probably be better off quitting my job, putting that 401k into a rollover IRA where I could have more control over it and make a lot more money. I really probably would be better off doing that. And I looked back at I used to be able to invest in individual companies, and I set up my portfolio quite well with like Visa, MasterCard, Chipotle, Google, Baidu, a whole bunch of these companies back in 2011, kind of at the bottom of that market. Now I was going to say, I'm just going to leave them in there. My company got bought out in 2011 and it all rotated over in 2012. And looking back at how much money I had in those companies, I would have been better off quitting my company, leaving those stocks in there, and I would have made more money in those stocks in my positions that I had than what I made at work. So the amounts of money I had in there, I had like, if I were to look at like Chipotle, I had like probably about 20 grand in Chipotle at that time in 2011. And Chipotle at that time was, I don't know, 220 and went all the way up to like 1900. So 1900, if it was 220 and I had probably about 90 shares, probably 90 times 1900. That's $171,000 in that one position. I also had about 20 grand in MasterCard. MasterCard at that time in 2011, let's call it about $26. So 20 grand divided by 26 times 380, $292,000. Visa was about the same thing, about $20. So 1,000 shares times 240 is probably where I would have swapped out 240,000. All this starts adding up. I had Baidu at that time. Baidu was very cheap. I actually think I had it in here, $44, because I had it a pretty long time ago. And I would have swapped probably in here 250 or so, 113,000. I mean, I had a whole bunch of really good positions, guys. I mean, they were so good. I had Chipotle. I didn't have Amazon. Oh, I had Google too. I had Google back here. I don't even know how much it was. I had the ones I remember that stick in my head were Chipotle, MasterCard, Visa, Google, Baidu. I had a couple more that absolutely killed it. Oh, I had no, I didn't have it at that time. That would have been no. So I would have made millions of dollars, multi-millions of dollars. And then they put me in some stupid ETF or index fund. That's not cool. So yeah, I probably would be better off doing individual companies now and quitting my job and actually swapping it all over. The problem is I got to have some income. I got to have income. I've got people to support, and I don't want to take my money out of investments. I think I could roll over that money into other investments, but since we have ETFs, I can still ride that, and we're in the middle of a big run, so I moved it kind of over into those ETFs. But I would do individual companies. That's what I would do. And if I had that opportunity again, if I see, the problem is, if I had that money, I would have gone into SM Energy at $1.50, and I probably would have put, I would have put probably 20 or 30 grand in it. So I mean, just looking at that, and you guys are making me sad now thinking about it, because let's just say I would have put like 25 grand to split it. 16,000 times 36, 600,000. My God. Man, it's depressing, guys. It's, yeah, I would have done individual companies. I would have bought in 2020. I would have done exactly what I've done in my other portfolio with the companies. I would have made probably a very large sum of money. Because that's a small portion of the portfolio. I would have bought a whole bunch of Deep Yellow, a whole bunch of Encore Energy, a whole bunch of Bannerman. A lot of these Bannerman is a 10 bagger almost. Encore Energy is up 400 or 500%. I would have bought Crew Energy, all those other ones that I own. They're all up quite dramatically. So yeah, I would do the individual companies. There's no reason not to. ETFs just bring down your performance. They take money from you, and in terms of what's it called, a expense ratio, and then they put a bunch of garbage in there that I don't like. So it says if you put a website online and I subscribe instant, I've been buying uranium since June of 2020, but no 10 bagger. If I get a 100 bagger via your website, I'll donate $500 for every household member of you. Yeah, so getting a 100 bagger is going to be, I think it's going to be tough from this point on. If you've been invested since June 2020, it might be possible to do it. So, says, I think you're right, but I think EV will get big in Western countries, and sales are up a lot in China. But countries like Africa will be buying all the old Western cars. They say people that buy EV will never go back to a petrol or diesel, that EV are that much better than. I know a lot of people, I've read a lot of articles that people went to EV and then they swapped back to the gasoline engine because of the charge times. It's a huge inconvenience to be charging an electric vehicle, and there isn't as many charge points. And it depends if you have one in your garage versus someone else. If you have one in your garage, then I could see it being awesome, and you don't take very long trips. If you take long trips and you don't use your garage, then I would see a gasoline vehicle being better. So that's what I think. They say have Steve St. Angelo on next. I could reach out to him if you guys really want him, but I don't think his viewpoint's much different than mine. I'm trying to find some people that have a little bit different viewpoint than mine. A lot of them I just don't agree with. I'm trying to get people on that have a similar viewpoint so I can see how they're playing it. There's really two ways to look at all of these investments. One is you have a macro thesis. Your macro thesis is how you view the world, the investment world, and what you think is going to do well, and what you think is going to underperform. I don't want to bring someone on who's 100%, 180 degree different, because I don't know what value that's going to bring, because I just completely disagree with them. And the second portion, which I think where is all the value and I can even benefit from it, is we share the same macro thesis, but what investment vehicles are they using to take advantage of it? And what are their arguments for, using this investment vehicle versus this other one? Are they using options? Are they shorting the other side of the market? Are they using warrants? How are they playing it? What companies? How are they evaluating those companies? How do they know which ones are the most leveraged? There's lots of value there, because I can't see myself, with all the research I've done, I can't ever come around to a deflationary standpoint if real estate is going up in price and we're going into an expansionary phase. I just think those guys are flat out wrong. All of them. Doesn't matter what PhD, I don't care. Doesn't matter. They're wrong, in my opinion. All of the data that I've seen in history, I can't see that type of scenario where we have an expansionary phase of real estate and have it be deflationary. There's no way. There's no way until that real estate turns around. But then I'll see it, and then I'll agree with their thesis. But I already know how to play that thesis. All you're going to be doing is either shorting the market or going into bonds. Shorting the market, I mean, you're going to do it at the top and get some momentum going down. You could probably make a whole bunch of money doing put options. And I'm not a put option expert, so I don't want to go too far into it. And to do it now, I wouldn't do it, because you want the real estate market to deleverage. That's a for sure deflationary crash. Everything's going down with it. That is where I would put the put on. I wouldn't do it if you don't have those conditions. I wouldn't try to time the NASDAQ bubble and the increasing interest rates pulling that down, or the sellers there. I wouldn't do that. So these guys that are talking for a crash, I wouldn't play it. The best way to play this would be with commodities, because you have the risk reward is so great on this, and you don't have to worry about going in and out. You don't have to worry about any of that stuff. So that's my take there. If you guys like this analysis, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.